Testing, 1, 2, 3. All right. Good morning. Good morning. How is everybody today? All right. We got a good group already. First thing in the morning, waiting for the morning bell. For those of you who don't know, my name is Lan Turner, former instructor of the Chicago Mercantile Exchange and the Board of Education Center. Currently an instructor of finance at Utah Tech University. And we have our options class starting next week. So I'm excited about that. And so anybody who wants to come and join who's not signed up yet for the options class down at the university, we're going to go through the academic side of options where you can be there in person with me, ask questions and learn about options. And then we're going to come here and all next week, we'll focus a little bit more on options. I wanted to do something a little bit with options today, just because we've been talking about different options over in the stock market. This is the futures market, of course, what we're looking at right here. And we're trading through the futures exchanges out of Chicago. And a lot of people don't realize that there's multiple exchanges that you can trade through. When people trade, oftentimes they just think about the stock market out of New York. This is out of Chicago. And it's the futures market. It's a little bit different than the stock market out of New York. There's no pattern day trading rules, and you can day trade to your heart's content with a smaller account. Over in the stock market in New York, you need to have $25,000 minimum to day trade. And over in Chicago, you just need to have whatever it costs to buy the margin. So we generally recommend you start, if you're going to trade the micro minis, the little tiny ones, at least $2,000. And then if you're going to trade the minis, you want to start with the minimum is probably $5,000. If you can do a little better, I would recommend a little better. It's better to be a little bit better capitalized. It doesn't put so much pressure on you, but getting started is not that hard. It's not as hard as it is in the stock market. Stock market to day trade, you have to have at least a minimum of $25,000. If you fall one penny below that and keep day trading, then they shut your account down for 90 days. And that's nasty. So figure on about $30,000 to day trade in the stock market. All right. So 5,000 here, 2,000 here in the futures market, 30,000 over in the stock market. And I'm not judging. You can do what you want. Most, many people have $30,000, and that's not a problem. So we can go day trade over in the futures market with 30 grand. Let's go do that. Or you can come over here if you don't quite have 30 grand to commit to day trading, then you can come and do it over here in the futures market and start with as little as 2 grand. So it's up to you. But this is the futures market, and these are the indexes in the futures market. So in the indexes in the futures market, we have up in the upper left-hand corner, we have the S&P 500. In the upper right-hand corner, we have the Dow. Bottom left-hand corner, we have the Russell. In the bottom right-hand corner, we have the NASDAQ. And what we're going to do here is I keep getting questions about, why don't you trade like those other guys on the other YouTube channels? They trade on the longer-term charts. They make $15,000 a day, Lan, and you're over here trying to make $500 a day or $1,000 a day. I don't understand. How come they are so much better than you? Okay. We can trade on the 15-minute chart too. I mean, we can do that. What's the difference? Let's do it today. Let's try it out. All right. First of all, the first thing we're going to do is we're going to come in here and we're going to look at the news. And the first thing I want to point out is the news has been very bad today. So we've got a very bearish market starting out here. And these are the 15-minute charts, because we're going to look at longer term trading and not so myopically down on the 1-minute charts or the range bar 6 charts. And I'm going to show you the differences. And it's very much the same as, well, do you want to take bigger risks when you get into the market, or smaller risks? And that's really what it amounts to. Are you going to look for a longer term trade throughout the day? Or are you going to look for shorter term trades and try and, scalp out a little bit of money here and there? It depends on your risk tolerance. But let's go through the news first. The bell's going to ring here just rang. So that's the bell. That's the opening bell. You see the market kind of fluctuating up there on that 15-minute chart, the Dow and the S&P. But down here in the news, we have some news. So let's talk about the news. All bad news. So the PPI, this is, if you click on it, you can see it's the Producer Price Index. And so the Producer Price Index, as you can see, month over month, it went up. So big jump up. So it was a forecast of 0.3, and consensus was 0.3, previous was 0.3, and it ended up at a zero point 0.6. So producer price index uh, for the final demand in the United States rose zero point 0.6 months over month, February 20th, marking the largest increase since August and surpassing market expectations of zero point 0.3 advanced. Goods price rose by 1.2%, the most in 6 months. So, in other words, producer price index, shit's more expensive. That's what that means. And no surprise, right? Elections have their consequences. All right, retail sales. So here we go with retail sales down, nasty down. Drop big in retail sales. Nobody's buying anything. They can't afford it. Producer price index went up. Retail sales go down. That's kind of expected, right? Core producer price index went way up. U.S. core producer price index shot through the roof. Bad news. All right. Initial jobless claims still way high, shot way up. Okay. Lots of people looking for work. Retail sales, not counting automobiles, okay, went way down. Business inventory, that's coming up here at 8 o'clock. So that's all your bad news today. Everything sucks in the economy. We all knew that. All you have to do is go to the grocery store, go to the mall. Nobody's walking around in the mall. Nobody's buying anything. So the market's flushing. That's what's happening here. We're seeing this big drop. Lan, I want to trade this big drop in the morning. Okay, well, we're on a 15-minute chart. We want to do longer term chart. I want to show you what that means. So we're going to come in here and we're going to use our dollar risk reward calculator, right? And let's say we want to get in on this drop and we think the market's going to fall because of all the bad news. So you're going to put your risk back at $348. Let's go ahead and we're going to just let's get into this thing. Let's pull them back, sell the market, and we're going to put our stop right up here above one price bar back, just the price bar entry bar. So that risk is $256 is what you're going to risk if you're wrong. And then where's our target? Well, let's say our target's down here. We say on the Dow, we're going to think it's just going to come down and touch this previous low. Well, that would be your profit potential of $900. Well, Lan, that guy on the other channel, he made like $15,000. Oh, okay. Well, let's do that then. Let's sell 3 or 4 or 5 more of these. Let's go in and let's do 5 of them. Let's do 6 of them. Why not? Heck, we got the money. Let's do it. There's 8 of them here. Let's do 10 of them. 9, 10. All right, let's do it. Okay, well, what are you risking on the other side? Well, you're going to do 10 of those. So we're going to come in and we're going to do 10 like that guy on that other channel does. He does 15, so I don't know why I'm only doing 10. That'll be $10,000 if that comes down to this price right here. You're only risking, what are we risking? We're only risking $2,564. So are you ready to step up to the bar and risk $2,546? We could. It's good, great bad news. So let's just look it in there, and there we are. We're up $1,500 already. It's all a process of what are you ready to do on your risk versus reward ratios, right? Are you ready to risk $2,564 for a profit potential of $9,000? And that's really all we're doing. It's no different than what we're doing when we're down on a smaller 1-minute chart. You're willing to risk $50 for maybe $100 or a couple $100, or are you going to risk $2,500 for $9,000? Now, in this case, it's working out like a charm for us. We're up $2,000 already. Okay, so it's just has to do with your risk tolerance. Okay, what are you willing to risk? Look at the Nasdaq. Nasdaq's climbing. Good thing we took the Dow short, not the Nasdaq. Right out of the gate, we're taking this short. So we're going to come in here, and now we're more of a day trader as opposed to a scalper, and we're going to just let this market run until we either get stopped out with a break even, because we can move our stop to break even at this point, but our dot for our trailing stop, as we all know, our trailing stop is way up here. So you're holding your stop way closer than you really should, right? But we're losing. We're down 800, 900 trade. Let's come in here. If we fall below $1,000, we'll just get out and keep our $1,000. But the thing is, what if it goes all the way down to $9,000 and we sacrificed it? That's the whole idea, right, of staying in. You think $1,000 is a lot, but you want 9,000. You're complaining to me that we don't make enough money because we're not trading big enough positions on big enough charts. Okay, well, stay in and risk the $2,500 for the $9,000. It's the same game you're playing. It's just bigger dollars. How deep are your pockets? Where do you want to go? What do you want to do? Well, that other guy makes so much money. Well, he takes such a big risk too. and that's it. That's more of a position style trade on day trading. So we'll just kind of sit here and watch this market for a second, see what it does. Maybe it'll flush all the way down to the previous low back here. And if it does, well, that's where we'll put our limit order and take our profits. All right. So we're going to take 10 of them off right here. And that's what that guy does, right? He just goes in and stays in until he gets 10, and he's all done for the day, and he's made enough money to live for a whole month. So the market falls. It's a great strategy. That's why I like to use options. But this gives us, we're only risking $2,600. What's our margin? Well, $10,000. We got $10,000 margin in there right now. And we can bring this in. We can bring our stop in. We can also do some other things. We can come in here and take some of them off. We don't have to leave them all on, all 10 on, but it's what's your strategy? What you're going to do? If it falls below $1,000, we said we were going to take it off, right? It's coming back, coming back. There it goes, falling again. So you just trade a longer term chart. Well, now we just fell below $1,000. Take it off. Okay. We're up $690. Now where are we going to get back in? Well, you shouldn't have got out, Land, because it's going to it's going to fall. Why'd you get out? You should have just stayed in. You had a good position. We were going to take this thing all the way to the white line. But look at the NASDAQ. NASDAQ's climbing. Did you want to risk that? So you just have less information. That's all I'm trying to say. When you do these longer term trades, you just have less information available to you. And so sometimes it's hard because we're on this YouTube channel to see what the way that I like to trade, which is to come in and trade with multiple time frames, right? So if we come in and we say, well, I'm going to just look at the Dow, let's come in and just do the mini Dow. Micro Dow, there's micro. Where's my mini Dow? Mini Dow. Oh, there it is, clear up there. So now we can see more information if we'll look at something other than just the 15-minute chart. So the 15 minutes chart is what we got into. Here's the range bar 6 chart. Here's the 1 minute chart. Here's the 2 minute chart. We can look at different time frames. I'm not saying it's bad to trade on a 15-minute chart. It's certainly perfectly fine. But the question is, if you're looking at the 15-minute chart and you're saying, well, I want to be short the 15-minute chart because it looks like it's going down. Okay, well, let's look at what that means. Let's put one of these on. Okay, we're going to go short the 15-minute chart. Well, you can see on a range bar chart where that's at. You can also see on the Dow 1 minute chart where that's at. You can also see on the 2 minute chart, you can see where that's at and how it looks in relationship to your 15-minute chart. Well, I'm going to put my stop 1 price bar back. Okay, on the 15-minute chart, I'm going to put my stop 1 price bar back, which is right there. Well, where's that on the range bar chart? Well, that's clear up there above the blue line. So are you going to let the market go all the way up there because you want to trade on the 15-minute chart? The point that I'm trying to make is that when you trade, you don't trade on the 15-minute chart. You don't trade just on the range bar chart. You don't just trade on the 1 minute chart. You don't trade just on the 2 minute chart. Don't get myopically focused on one time frame. And maybe that's where I'm falling short in being a teacher for you, is that we do that a lot. We stay myopically focused on one time frame, like the range bar 6 or the 1 minute chart, and we don't move out to the longer term charts for longer term trends. And part of the reason, give me a second, I got to drink some tea. And the reason we do that is because, again, we're hamstrung. We're hamstrung a little bit here because we only have one monitor that I can show you at a time. So if you start seeing the range bar chart going against you and you start losing money, you have to ask yourself, how much money am I going to let it go? Am I going to let it go all the way back to, that's a lot of money, $340, just so I can say I'm trading on a longer term chart. I'm trading on the 15-minute chart. So what we need to realize is that once you get into the market, you move out to a longer term time frame, out to a longer term time frame, out to a longer term time frame. And you try and get yourself into a position where you can take those longer trades. Oftentimes we don't because we like to scalp the market, take our $100, let our market run on these smaller term time frames. But the fact is you can trade these 15-minute charts if you can get into a position that is a 15-minute chart long trend. But if you're sitting here looking at the Dow and it starts to go against you, it starts to rally, why stay in and take a $340 loss just because you're like, well, I want to trade a longer term trend? I think it's down overall. Okay, fine. It's down overall. Let's just get a better entry. Let's not lose $340 in our attempt to say that we're trading on a 15-minute chart like that guy in that other channel. Do you want to just, the point I'm trying to make is that you can have more information than just one chart. And everybody wants to make $15,000 in one day. Sure they do. Is that guy trading real money is the big question. Is he really doing that with real money, or is he just doing what I just did? Just randomly come in. I'm in a demo account. Why the hell not throw on 10 contracts and risk $3,000? Do you want to risk $3,000? You don't have to is the point. The point I'm trying to make is you don't have to risk that much money if you don't want to. I mean, it's I get that all the time. I would rather go watch that other guy because he makes way more money than you do, Lan. Well, he takes way bigger risks than I do too. All right. So I'm trying to help guys that are just getting started. If you're just getting started, I wouldn't recommend you trade 15 contracts at once. That's all I'm saying. Let's start with one contract and build our position. Let it go. Let it run. Cut your losers short. Let your winners run. But if you're losing, why stay in? What is considered a losing trade to you? Well, I'm on a 15-minute chart, so I don't lose until I get stopped out one price bar back. Okay, well, that's a $340 risk. Are you ready to risk $340 of your account so that you can be in for a longer period of time? Maybe you're willing to take a bigger risk, okay? Right here. I'm just saying you don't have to. If it starts to go against you, you can get out. You can always get back in. Take a $2 loss or $5 loss or $20 loss rather than a $340 loss. And if you're going to trade for a long-term trade, like that guy on that other channel, I watched him and he stayed in for 5 days in the S&P 500, and he made all this money because he stayed in the market for 5 days. Well, that's not day trading, for one. Two, there's nothing wrong with that. You can certainly do that. I wouldn't probably do it with a contract because your margin jumps up so high, right? If we go look at the margin, margin goes from day margin of $750 on the Dow all the way up to initial margin $9,240. And if you have 15 contracts, you do the math. 9 times 15. Oh, but he held it for so long, Lan. He just gets rich beyond my wildest dreams. Well, you can do that. Let's just do it with an option. All right. If you think you want to stay in a market because you're looking at a daily chart and you think the market's going to fall for the next week or two, because that's what the technical analysis is telling you, and you think you want to capitalize on that, do it. I'm not saying not to do that. We can certainly do that kind of stuff. You can come in here and drop an option in here. You think the market's going to fall because of all that bad news? Come in here and buy an option. 14 days. There we go. Let's come in here and we're going to buy a put because we think the market's going down, right? Go buy a put. There we go. We'll put that one in there right there. Oh, we got to hold on. We're not going to do that in this market. We got to do it in the S&P. There's no options on the Dow. Okay, so we're going to bring this stop down. My point is we're in the market. Why risk $340? If it comes back and stops us out, just get out. You can let the market run. Let it run all day long down if it's going to stay below our entry point. That's the point, right? But if we look, we can get in with a second one. You can put another one on. We're only in with one. Well, I should have got in with 15 like that other guy. Okay, well, put in 15. What's your risk? Even if you're going to risk back just a few dollars, 15 contracts on a small move, that's one contract's $85. 85 times 15. How far are you going to let that baby run against you before you're going to say, I think I better get out? That's all I'm saying. That's all I'm saying. You want to trade on longer term time frames and say, well, now my goal is to see this market go forever down. All right, let's go over to the S&P. We're at break even at this point. I think this is a better plan. That's all I'm saying. I don't think you need to risk $15,000, $3,000, $4,000, $5,000 because you're trading myopically on the 15-minute chart. if you can see what's going on here on the range bar 6 chart, reduce your risk, get your position in, bring it to break even. If it goes up and stops you out, you get it stopped out with nothing, no loss. As opposed to on this one, if you're just going to myopically trade on the 15-minute chart all the time, well, your risk is going to be much significantly higher. And then if you're going to do the 15 contracts like those other boys do, you're taking giant risks. And I'm not saying it's bad. If your account is $1 million, then 15 grand ain't nothing to you. Go do it. But most of the guys that I'm dealing with are starting off with a little bit smaller contracts. So we try to do a little bit smaller trades. That's all. So we're up $150 right now. We're up $190 on this move. As the market starts to come down, we got our stop move to break even. At what point do you want to take the profits off? Do you think it's going to continue to tank? Well, we think it's going to go to the floor. We think it's going to fall. All this bad news, just leave it right here then and move out to a longer term time frame. Move out to a longer term time frame. That's the whole idea of having multiple time frames in your series, is that you move once you get your stop move to break even on the range bar chart. Well, hell, you don't need it anymore. Close it. All right. If it's bothering you, bring up the 2-minute chart, close it. You don't even need it anymore. All right. Now we're looking at now we're trading off the 2-minute chart and the 15-minute chart. Has our yellow dots got to break even yet? No. What about over here? Well, our yellow dots haven't got to break even yet. Well, I want to keep it for 5 days, Lan. I don't want it to ever get out. Okay. You might want to do, if you're going to do that kind of contract trading, you might want to do that over in the futures market or over in the stock market. Of course, you don't have the leverage, so you're going to need a huge amount of money to make this kind of money. So if we come over here to the key once again, if you keep it overnight, you're going to have to go up to $9,000 per contract. Now we only have one contract in. Maybe I should have done 15 like that other guy, right? And we'd be up making money so fast that you guys would have your head spin. It's all available. You can do that. I'm not saying you can't. I'm just trying to help you guys stay cautious in the beginning so that you're not risking $3,000, $4,000 and have that thing just go against you and lose all your money. Try to save a little bit of your money for you. If you can catch a big trend like this is great. Oh, I want to go longer, Lan. I think the market's going to keep falling. Okay, well, let's go out to a 5-minute chart then. Okay, so this is a 2-minute chart. We haven't got our yellow dots, haven't got to break even yet. So we can't even start trailing yet on this 2-minute chart. But we can come out here and we can change that, change it to a 5-minute chart. Now we're trading on a longer term time frame. How's that? Now there you go. So you're trading on a longer term time frame. Now you're going to just use different patterns that are for this time frame. And again, it's just bigger risks, bigger rewards. How long are you going to let it run? It's dropping. We're up $500. Now, if we came down and we were on a smaller time frame chart, let's go back to a range bar 6. We could be doing we could be trading, so the King Tut, which is, doing a pillar all the way down. But right now we're just in with one contract. I want to add another contract. Oh, look at this pulling back. Are you going to we're not trading on this chart anymore. Remember? Nope, you can't get out of here because we're not trading this chart. We don't have this chart. We closed it. We have to go for a longer term trend. So we're going to just stay in like this. How far are you going to stay in? Did it come down and meet your goal? Our goal was this right here. Did it touch it? No, it didn't touch it. So are we going to stay in? Where are you going to put your stop? If all you have is the 15-minute chart like that guy, this is what we're looking at. What are you going to do? I'm just going to stay in. Okay, well, let's just stay in. Just stay in. You're going to put a limit order in here? No, I want to be in there. I think the market's going to fall forever. I don't think it's ever going to come back to this point again. We're going to just keep going down, 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 down. Okay. Then don't put your limit in and don't take profits. It's working out like a charm for us. Are we going to put our limit order in? Are we going to take our profits if it touches the previous low? That was our initial goal, right? Let's see if it'll do it. We only have one chart. We've closed all the others. We can't even see them. There's a 1-minute chart. That's what it looks like. Come on, baby. Touch it. Go all the way down. Your stop's at break even. Do you want to bring it in? Come on, get down there. Come on. Yeah, we're on a 15-minute chart. What does it look like? That's what the range bar chart looks like. Is he going to go down there and touch it? You got more information. That's all we're doing. We just have more information. How much? Where do you want to stop it out? Where do you want to say I've had enough? Where do you want to bring your stop to? You want to bring your stop down to here? How much would that lose if it went back up and touched us? $210 out of your $700. Do I want to bring it down to here? Right here? Where do you want to bring it? What do you want to do? That's the only difference. Is you have more information when you're trading on a shorter term chart. You hit your limit. You're happy. We're done. Done for the day. Look at that. Man alive. Holy cow. There's our 1 minute chart pattern right there. And that thing dropped right out the bottom. Holy cow. That was some bad news that came out for us today. So there you go. Trade on a little bit longer term chart. The whole point is that once you get into a position on a shorter term chart, you should be moving out to the longer term charts, the longer term charts, the longer term charts. And I think I've tried to reiterate that and make that clear. We kind of get myopically focused because we like to look at four charts, four different markets simultaneously, and we do a lot more scalping. But man, we haven't had this kind of an opportunity in a long time. That's a big, that's a big drop. Wow, that's crazy. So if you can catch these big trends like that, that's a great thing. You can get in there and go out to a longer term chart, out to a longer term chart, out to a longer term chart. But if you start on the longer term chart, like that guy on that other channel, he starts on a 15-minute chart. It's fine. I'm not saying that's not a bad thing. I'm just saying you're taking a lot bigger risk to do that. Okay. It's not that you shouldn't be looking at the longer term charts. I say it all the time. You got to look at the longer term charts. Sometimes, admittedly so, I forget that step and I don't do it. I just go in and start looking at the 1 minute charts with us as we watch the ponies run out of the gate, right? But I have to say that it's because we get stuck on, we only have one monitor here. We have more monitors, we can see more things. So we have to just deal with what we got. Should we trade longer term charts all the time? Maybe we should. Maybe we shouldn't be focused so much on the range bar 6 chart. But we need markets to make bigger trends too. Once you get in, we move out to longer term charts. Okay, we'll start doing that more often. We won't be quite so much of a scalper and try and do longer trades. But we got to get longer trends to get longer trades. That's the problem. Don't get trades like this very often. All right, what's it going to do now? Came down and hit our target. Is it going to turn around and go the other way? Do we want to put 15 contracts into the long side now on the rebound? Well, where are you going to put your stop if you do? How much you're willing to risk? Let's do 15 contracts, just like that guy in the other channel. We're going to go long on the rebound. Have we hit the bottom? Or is it going to go down some more? There it goes, dropping again. Well, you can go short if you want. Take another 15 contracts short. Is that what you want to do? Where would you risk? I'm not saying you can't trade with bigger share size too. Go for longer term trends. You just got to get a market that's going to give you some longer term trends. That's what scalp and trail is all about, right? You scalp some off so it covers your expenses, and then you let the other one trail. And man, if you can catch a trend like that with your trailing stop, that's why I do scalp and trail. It's because if all you're doing scalping all the time, you miss these big, huge, long runs when they actually do occur. Okay, we think it's going to rebound, or we think it's going to come down some more. I think it's going to rebound. Okay, there's our 15 contracts. Let's take stop and put our stop right there below that low point. What's your risk reward ratio? Well, we're going to expect it to come all the way back up to the blue line. What if it doesn't? Well, you could get out on a 15-minute bar, but you got no support over there. That's why I come down to a smaller term time frame. Say, where are we going to get out? Oh, look, well, it's coming back against. We're already down $600. But that's okay because, hey, we're trading 15 contracts on a 15-minute chart because that's what we do. Because we're always right. We're right every single time. So we can take 15 contracts. We're never wrong. We never get stopped out with a loser because we're never wrong. Trade like that guy on that other channel with 15 contracts every single time because we're never wrong. We're always right. We always know which direction the market's going. We put our stop in there. And if we get stopped out, heck, we don't lose anything. We just lose one little price bar back. Oh, damn, we're down $2,000. Well, that's because you picked the wrong direction, Lan. We all knew the market was going down. Why did you go back up? Well, because we're always right. We're trading with 15 contracts. That's what happens when you trade with 15 contracts. No, that other guy, he never loses. I watched him. He's never had a single loser. And when he does, it's like $1. Oh, okay. Well, he always trades 15 contracts, though, because he never loses. He's a lot better than you. He knows what he's doing. All right. Well, what do you want to do? Market's still coming down. You think it's going to rebound and come back up, or do you think it's going to go down? Well, the 1-minute chart's still going down. We took 15 contracts looking for the rebound. It didn't happen. We got stopped out, but it wasn't very much money, only $2,000. Well, I wouldn't have taken that big a risk. Well, what risk would you have taken? If it would have gone against me, I'd have got out. Well, it's going down now. You're going to get in for a short position on a break below that continuation? Is this a good place to go short? Maybe. Let's go short 15. Where are you going to get out if you're wrong? Well, I would get out if I was wrong. Let's see. I'm going to get out if I'm wrong. Where am I going to get out? Oh, I'm going to get out one price bar back on the 1-minute chart. Okay, well, let's do that. That's way up here. Okay, it's starting to fall in our favor with 15 contracts. Now we're up $1,500, $1,300. It's all relative. It's all relative. You can do it in a demo account. It's really easy. It's really easy to do this in a demo account. 15 contracts. But when we lost that $2,000 and that was a real money account, would you have your butt pucker up like that or not? People get after me and say, oh, you don't trade big enough positions. You don't make big enough money. All right, we'll trade 15 contracts. Let's make some money. Let's get serious here. It's the demo account. Who cares, right? Oh, what are you going to trade like when you get real money? Oh, well, I'm going to open my account up with $2,000. And that means I can trade. Can I? It's a $750 margin, Land. Doesn't that mean I can trade four contracts? It does. Do it. Don't get stopped out ever. Don't ever get stopped out. You better damn well be 100% like that other guy who never loses, always a big winner, right? Always a big winner. Okay, bring your stop to break even. There we go. That's all we have to do. Now, close that market, close that chart altogether, right? Close it. We don't even look at it. Close that one. We don't even look at it. Just keep riding it down. 15 contracts, just like that other guy. How far is it going to go? How far is it going to go? Everyone's bailing out. See, you have less information. You can't tell what's going on because you don't have your range bar chart up. Gives you a little bit more information. That's all. Starting to come back against you. You have less information. What are you going to do? All I'm saying is that when you work with these smaller time frames, you have more information. Starting to come back. That's a lot of money with 15 contracts. That's $700. $70. 15. That's 700. So it's more than that. $1,400 for the 15 contracts. $70 per contract. You want to move your stop down? We can move it down right there. We got more information. What happens if we get stopped out right there? Well, it might continue to fall. Yeah, it could. Okay, you just got stopped out. Your 15 contracts, you're up $1,200. Good thing we got out. We had more information on the range bar chart, right? You just have more information. Maybe more information is not good for you. Maybe you don't want more information. Maybe you'd rather just have, even 1 minute. This is amazing on 1 minute chart. We trade 1 minutes all the time. We don't get trends like this very often. What do you want to do now? What do you want to do now? We're trading 15-minute charts, right? Trading 15-minute charts because that's what that other guy does. What do you want to do? This is all the information you have. Smallest chart he looks at. There's your daily chart. I want to see a 1 hour chart, man. 1 hour chart. Okay, there's your 1 hour chart. That's what a 1 hour chart looks like. Let's turn on Heiken-Ashi. There's what 1 hour chart looks like. I would recommend that if you trade like this, you do it with an option. If you want to go for an all-day move, let's come over and look at an option. And we've done that before, right? We do that with options all the time. Indexes. I want to find the S&P 500. Mini S&P right there. Okay, we think this thing's going to fall for a long time for the next 10 days. We'll just come and do it with an option. That way our margin doesn't go through the roof. All right. So do 14 days and we'll buy a put. And we're just going to drop that in there. Now that's $2,200. What's your max loss? Well, it's the premium you're paying for it, $2,500 or $2,100. But your margin's not going to go to the moon, right? So there's $2,450 short position. Go ahead, buy that. Market order, place it in there. Okay, now you got a short position that you can hold for the next 14 days. So if the S&P 500 falls over the next 14 days, this is, in my opinion, a much better way of doing it than to try and hold a contract overnight. Not that you can't, you certainly can. Well, that other guy does. I saw him. He took a gold position and he went short for 15 days. Okay, do that then. I'm not telling you can't do that. Lots of people trade lots of different ways. Well, he makes a lot more money than you do, Lan. I know he does. He's rich, rich, rich beyond his wildest dreams. How old is he? 12? Yeah. Okay. I believe him. I believe him. It's real money. It's real money. He's really doing that with real money. I know he is. I know he is. Now, I trade my own real money and I have a lot of money. I'm not bragging or anything. I don't have like Warren Buffett money. I'm not. I'm just got. I'm well off, and I don't trade like that. I don't take those risks. Okay, I think this is a little bit better way to do it. You're going to do it with an option if you think the market's going to go for a long time to the downside. Okay, looking on our range bar chart, we got our little call to arms down here. Happened right there. See how it turned and went from red to green? Market's starting to go up. We're coming up above. Now again, we're starting to look down in these little small time frame little charts. This is range bar 6. If you're still over here on the 5-minute or the 15-minute chart, you're still in a big downtrend, right? Hasn't even broke the previous high. So you just more information. That's all. We're just going from 15-minute to 5-minute to 2-minute to range bar 6. All I'm saying, smaller time frames give you more information. If you can catch one of these big trends, great. I think you should catch it on the range bar 6. Move out to the 2, move out to the 5, move out to the 15 if you want to go for a longer term trend. But I say we start down here on the smaller time frames, get our positions in, move it up. And then if it feels like on a 2-minute chart or a 5-minute chart that market's got a lot more legs in one direction or the other, which we haven't had very often, right? I mean, you have to admit, we haven't had big trends like this very often. These don't happen very often for us lately. Now, last year was a different story. 3 years ago was a totally different story. We get trends like this every single day. Of course, they were in the up direction. We just like boom, and the market would go up forever. It was easy. Everybody was making money. It was like falling off a log. You couldn't lose. Everything you bought went up. 3, 4 years ago, it was just like, before Corona, that market was just going straight up. You couldn't everything you put in, you made money. It just went straight up. And then Corona came and the market fell, and everything you put in to the downside made money all the way down. And then a Corona correction started to go up, and it was the same thing. You throw your money in there, it didn't matter. Everybody was making money. I know guys that had no clue how to even trade, making hundreds of thousands of dollars. And then I've also seen some people lose hundreds of thousands of dollars because they thought the market was always going to trade like that. And then they discovered that, hey, it doesn't always trade like that, but they were still trying to trade as if it was. And I watched one guy in particular, not going to say his name. I watched him lose $3 million because he thought the market was still going to continue to trade as it had been during those wild and crazy days. And he kept trading as if it was, and it wasn't, and just kept giving it all back. I told you, I know a trader, another trader who put $1 million in. Took him, what did I say? I think it was like 8 months to lose it all. Started with $1 million. Took him 8 months to lose it all. Just because you have a big account doesn't mean you're going to make a lot of money. If you can't make a big account, if you can't make money with a $5,000 account, you can't make money with a $1,000,000 account. It's all about risk management and about the opportunity that the market presents to you and how you capitalize on it. On the 15-minute chart, if that's your smallest time frame, that's all you're going to look at, because that's what that other guy does. He only looks at 15-minute charts. Okay, well, if he's still short, the market's already come back against him $687, and he's still short, right? Because this is all the information he has, 15-minute chart, and he's got 15 contracts. So it's 687 times 15. That's what is pulled back. Oh, he took his profits already. I thought you said he was staying in all day. Both can't be true. See, we were going to go with the rebound. We tried once, but I didn't want to I wanted to be like that guy. I wanted to trade for you like that guy, because everybody's always telling me you should trade like somebody else, Lan. I should trade like I should trade. You should trade like somebody else. Well, why aren't you making all that money now, Lan? If you're so smart, why aren't you going long right now? Well, because we're short, because we're trading like that guy on long-term 15. You see the marquee out there. Trade long-term trends, not short-term trends. This is just a small counter trend. Just a small counter trend. That's all it is. The market's going to still fall again, right? Just a small counter trend. We're going to stay in all day at this position. Of course, I did it with an option. All right, I wanted to actually show you, now that we've played over here. Hopefully this was a decent lesson. You understand what I think. It's better to have more information. That's all I'm saying. You should trade off of multiple time frames, and you should trade starting on a small time frame so you don't take huge risks, and then let your markets run. Scalp and trail. You want to scalp a little bit in, get in with a couple of contracts. You want to get in with 15 contracts, get in with 15 contracts. I'm not telling you not to get in with 15 contracts. Where are you at in your trading? Are you able to put on 15 contracts? And when you get stopped out, say, hey, that's no big deal, because when I make money, I'm going to make money with 15 contracts. Or are you going to be the guy that gets in with 15 contracts, takes the first loss, and he's down $3,000, and then says, oh, I'm not going to trade with 15 contracts anymore. I'm going to now only trade with one contract because I just took a big loss with 15. What's that going to take you? What's it going to take you to now trade with one contract to try and win back the profits that you had with 15? Or the loss that you took with 15. Now it's going to take you a month to make back the money trading one contract because you got scared trading 15 contracts. We had an article in Pitt News Magazine about that. It's called pyramiding. Do you start with a big base pyramid and take it off as it goes up? Or do you start with a small pyramid and add on as it goes up? And I think neither one are a good idea. I don't think you should start with one and add and add and add and add and add as the market goes in your favor, because you get an upside down pyramid, and the market pyramid only has to drop. The market only has to drop 2 pennies, and man, you lose it all because you got an upside down pyramid. If you start with a base pyramid of great big huge 15 contracts all at once, well, that's great. It's great if you're right, but if we're doing that, how many times are we right thing? If you're 50% right, 60, 70, I usually trade. In my real money trading, I'm right around 60 to 70% right to at least get to a break-even point and a profitable point. I can usually be 60 to 70% right. Most guys can't do that. They're lucky if they're getting 4%, 4 out of 10. And we know that from our scales that we've looked at in the past, 4 out of 10, you're still profitable if you're doing a 2-to-1 or a 1-to-2 risk versus reward ratio. So you're still profitable at 4. So if you can do 5 or 6, which is where I'm at, 5 or 6, sometimes I can reach up into that 7. Not very often. I'm usually right around 5 to 6% of the time I'm right. Well, if you're wrong just one time and you got 15 contracts on because you're going to start with a great big base and take them off as you go in your favor, that's a hard way to trade, because if you're just wrong one time, bam, And then you can't drop down to a 1-minute chart and start saying, well, or you can't drop down to a quantity one, because one, it's going to take you 2 months to recover that loss from 15 contract loss. That's all I'm saying. So I'm saying it's better to pillar. It'd be more conservative. So when you pillar, you get in with maybe 1 or 2 contracts there in the beginning. I like 2. So we get in with 1, and if it starts to look like it's moving in our favor, we stick that second one in as fast as we can. We let our market go, and then you can pillar, right? You, as the market moves in your favor, you add one in, take one off, add one in, take one off, add one in, take one off, add one in, take. Are you going to make as much money as if you built this giant pyramid? No, you're not. But you're also not going to lose as much if you're wrong. And so it's just a different style of trading. And I've been doing this a long time, and I've seen a lot of guys blow their accounts up. I own a brokerage firm. What do you think? You think I don't know what's happening out there? When you have 400, 500 clients all trading, you know which ones are blowing up their accounts. You know which ones aren't. I know what they're doing. They're building pyramids and they're blowing up their accounts. Don't do that. I'm just trying to tell you, be very careful. These guys on YouTube's, I would say 98% of them are not trading real money. They're taking giant risks. And yes, they show big profits. But we can all do that with a demo account. That's not hard. You got to get to the point where you can trade a real money account like that, and that's fine if you can get there, okay? But most of the guys in my class is brand new. They just barely started. So why would I come in to some guy who's never traded before and start telling him, you need to trade with 15 contracts like I do, because I've been doing it for 20 years. And most of these kids haven't been doing it for 20 years. They just started last week themselves, and they started a YouTube channel. Just saying. Abert, that is some very wise advice right there. Where to go? So proper trade management is critical controlling risk. Absolutely. That's the key. Taking positions in a market is not the biggest thing of trading. The biggest thing is controlling your risk and managing your positions. Everybody wants to catch these big trends. You got to have a big trend to catch, and you got to know what the setups and triggers are to get in. What do I think about entering an options trade at 45 days as others advise? 45 options. Well, it depends. It depends on your time horizon, Ebert, doesn't it? Depends on your time horizon. When you're trading options, it has a lot of things to do with how long you want to stay in the market. So we're going to do our longer term trends, right? So if we're going to come down, and I always say I want double the amount of time that I think the market's going to take to make my position, and it all has to do with time decay. So this is a daily chart. So in this case, we took a short position, and so we only have 14 days on this one. So you have to come in, and first of all, you have to see what's available to you. You have 14. Now, I know there's all these in here. These are all the weekly charts, but most of us trade the monthly chart. So the next one you have is 47. You can do 47, and then you have more time, right? But it also costs you more money. So if we're going to come in here, we're going to buy a put. In this case, let's put one in there with 45 days. See the difference? So if we put it right at the money, that one's $4,362 for 45 days, whereas the 14-day one was $2,450. Let's buy one of each, shouldn't we? Let's do this. So if you have that question and you want to know, well, go do it and see what the difference is. Now I want to show you something else. We're going to come in here, and 4,362 is our cost to buy this put option for 47 days, whereas for 14 days, it's $2,450. So we're going to go ahead and we're going to mark it into that. So we got another put option. So now I got two put options. One cost us $4,300. The other one cost us $2,450. One's got 47 days. One's got 14 days. Now let's do some simple math. Let's say I'm wrong. You got to always look at this from worst case scenario. So I got my little calculator here. So let's do just some simple math. All we're going to do is we're going to take 14 days and 2,450. So we're going to say $2,450 divided by 14 equals $175. So we're going to lose $175 in time decay, right? It's called theta. So let's write that down. So we're going to lose $175 per day. All right. That's on the 14 day. Now, if we do the same thing on the longer one, we're going to take $4,362.50 divided by 47 days equals, and it should be quite significantly less. It is $92. Okay, so now you're going to lose $92 a day in time decay. So now it's $92.81. 81 cents, and that's for the 47 day. So what's that telling us? What that's telling us is that one, we have a greater expense to buy the 47 days. It's going to cost us $4,362 for a longer term time frame. Why? Because we're buying longer time. But on the other one, we only have to pay $2,450 for the shorter term time frame for 14 days. But the time decay, the theta falls off faster towards the end, right? So it's kind of I have that chart here somewhere. Where is it? Where is our theta chart? There it is right there. So this is what happens. Your option's time decay, right? So you have an option, and as the market goes down longer, shorter, the time decay has a much faster decay. Man, that's not a very clear picture. I'm going to have to get that updated. But you have your time decay. So you can see it's kind of shorter. It doesn't decay as fast, and then it decays much quicker towards the end. So when you buy more time, you are trading out here in the flatter area. You're not going to lose as much money. So just taking it and saying, well, it's $92 for this one, $175 for that one, not really fair, because it's going to drop off faster towards the end. So the $2,450 option that you paid half as much money for is going to die more quickly. So what does that mean? That means that the market has to increase in value faster than the time decay is dying on the option. So you're going to lose $175 on the shorter term option every single day, which means the option or the market itself has to move in your favor $175 every single day just to break even. Now, of course, that's not perfect because, again, it drops off faster towards the end, but just to kind of give you an average. Whereas on the 47 day, it's only going to drop $92 a day. So the market only has to move in your favor $92 a day. So why would you buy more time? Well, the reason you buy more time is because you want to operate out there in that time where the decay is not as fast, and your market only has to make $92.81 a day to break even. Now that's in your table down here in the options. So if we come down here, and if we come into our options chain and we just go to, we're doing puts, premium per day. See that? So I'm going to hit center, bring it in here. You can see it's right there calculated for you in this table. See that? It says $92.29. We calculated $92.81, right? I did it on my calculator. You saw how I did the math? It's in a column right here for you in the software. So premium per day, all right, $92.29. Now, if we go to the other one, which is the 14 day, should be the same, 173. Now we calculated 175. The real number is 173.21. Can you see that? See how I did that calculation? So that's why that column is in there where it says premium per day. Now, if you're looking at the software and yours doesn't say that, you don't have that column, just right click on the header, column settings, and you can come in here and turn it on. Now, if you're not using Track and Trade and you're using another program and it doesn't have some of this information, nothing I can do for you. You're gonna have to do the math manually. But Track and Trade does that column for you. All right, it's right there. Premium per day. How much are you going to lose? $173. And that's what that theta that's what that means. And So the closer you get to expiration. So then the question comes in, well, Lan, why don't I trade with even a longer option? Come in here and do a 99-day option, right? So we're going to do a 99-day option. So we're going to come in, and I saw you actually ask that question yesterday, and I thought that was such a good question. I was going to actually focus on that question today and in the marquee, and then I forgot that that's what the question was you asked. I was like, what was that question you asked? It was a really good question. So now we're going to come in and we're going to buy a call with 99 days. Well, that one's $6,000. Let's put that one on there. Actually, that's a call. We don't want a call. We want to put, right? Because we think the market's going to fall. Buy a put. And we were just doing this as an example. So we're going to put that in there. And that one is $6,975. So let's come in here and we'll mark it into that. We'll put that one on. Okay, so now we have three options. We have one we paid $6,975 for. We have one we paid $2,450 for. We have another one we paid $4,362 for. You see that over there in that left-hand side? That's what that's showing you. So now we come down here and we can see if we go to the 99-day option, how much are we going to lose premium per day? It's only $70.20. So let's put that in there. So on the other one, this is going to be $70.20. 27 cents. Let's not forget this 27. So that's the 99-day option. So this is why you would do one versus the other. You're going to have to pay more money for it, right? You have to pay more money for it because you're buying more time, $7,000. But your time decay is only going to be $70 a day. $70 a day. So that means the market only has to make $70 a day. The market has to move in your favor, $70 a day, just to cover your expenses of owning that option. So that's your break-even point. Market has to make you $70 a day on average to break even. If it doesn't make that, you're losing money. Okay, you're going to lose money in the time decay of the option. So on the 47-day, you have $92. 14 days, you have $175. Let's do one more, okay? Because let's do a one-day option. All right, so we're going to come in here and we're going to buy a put. Since we're doing puts, we're going to buy a put with a one-day time frame. So how much is that one going to cost us? Well, it's only going to cost us $1,612. Let's put that one on. Let's mark it into that one. Okay, so now we got a put that's cost us $1,612. So let's go look at that one. So what's our time decay on it? Premium per day, $643. $643. If that thing doesn't make $643 in each day that we own it, we're going to lose our money. It's got to make at least $642. Now, can the market move fast and drop fast and that thing show profit? Sure, it can. It can outperform the time decay. Because remember, even in a 2-day option, your time decay has a curve to it. So if we have a 2-day option, it's going to expire tomorrow. That means all day today, we got kind of the top of the curve. So it's going to lose money tomorrow a lot faster than it is today. So if we just want to trade today, we can get a 2-day option. Our option is going to have, let's say tomorrow that option is $1,000. Well, that means it's going to lose $1,000 in one day. All right. But here for us, it's $1,612. Well, it's going to probably lose about $600 today, right? Actually, how much did it say? $700. It's going to lose $700 today. On average, every day, it's going to lose $700. So $700 today. Tomorrow, it'll actually lose the full 1,000 because it'll be a one-day option tomorrow, and you have just one day before it expires. So that's a 2-day option. Okay, let's type it in there so you can see. We got $712 on a 2-day option. All right. On a 2-day option, you're going to lose $712 a day. So that's kind of the difference between these different time scales. Why would you buy 47 days? Well, because you want a smaller time decay. You want a smaller theta decay, but you have to pay more money for it. You have to pay $7,000 for it. So therefore you have more at risk. You have more money you can lose. It all comes down to your technical analysis, your analysis of the market. How far do you think that market's going to move in one day? Do you do your Fibonacci projections? Do you do your Fibonacci retracements? Do you have news on your side? Do you have these things in place that can help you make a better trading decision? And then do you want to put up more money to be able to capitalize on that so you have less time decay? Or do you want to put up less money because you only want to take a shorter term time trend trade and capitalize on just a smaller move and use their leverage to help you make more money. But you're going to have to play against that $712 if you're going to do a 2-day option. Now, we oftentimes do 0 DTE options, right? 0 days till expiration. So let's come in and do a 0. Well, we can on this one. There's not one. So the closest we can do is 1 day. And that's going to be tomorrow. Today is what? What's today? I don't even know the day. Is today Wednesday? Oh, today's Thursday. Oh, that's why. Tomorrow's Friday. So Friday's the expiration date, and that option is going to expire at the end of the week. All right. Does that help answer that question? Oh, good. Glad you just purchased TNT. It's a good software program. I think you'll enjoy it. It was designed to help you understand things a little bit more clearly. It's a very visual software application. It gives you a visual representation of your options in relationship to the trends of the markets. And so that's one of the things, that's the way we designed it. So it's really nice. I wanted to actually take you over to the stock market, and I wanted to show you, because Michael Bruce has been talking about what we've been doing over in the stock market as being poor man covered call, which it is. It's poor man's covered call, but I wanted to put on a traditional poor man's covered call because I didn't want to be, I want to make sure we have full disclosure here. Not that it's disclosure, it's just more information. I'm trying to teach you a little bit more. A real poor man's covered call, what we're doing here is more of a bull call spread, Michael, where we buy a call and sell a call. So we buy a call and sell a call, buy a call at the money and sell a call. It's kind of a bull call spread. The reason it becomes a poor man's covered call is because our time frame on our bought put or our bought call is longer than the one we're selling it against. That's what makes it a poor man's covered call. But traditionally speaking, a poor man's covered call is more like this. Let's go find one we can do one on. Here's Amazon. Okay, so we're going to do a poor man's covered call on Amazon. So let's be more specific. So what we're going to do is we're going to come in here, and the poor man's covered call means that what we want to do is we want to come in and we're going to buy, let's do another 100 days, 127 days, 155 days. Let's go see what one costs. It might be pretty expensive. Our account is running low. We got $46,000 in buying power. We should be able to do this. All right. So a call option on Amazon, and we're going to do a traditional poor man's covered call. What we want to do is we want to come down and we want to mimic with our option the closest thing we can to 100 shares. And that comes down to your delta. All right. So your delta in here, we want to come down to as close to delta of 100 as we can. We generally go to 90. All right. For a poor man's covered call. So you're going to buy $6,642 option. So you're going to buy that deep in the money option. Okay. And the reason we're doing that is because that gives us a delta of 0.90, which is almost one to one, which would be the same thing as owning the stock, right? We're 10 cents shy of owning the stock out of a 1-to-1 ratio. Now that would be more of a poor man's covered call. That's the traditional one where you come down here, you buy the option with a delta of 0.90. Does it mean you can't come up here and buy an at the money option and then sell your call above it? No, it certainly can. It's just that if you want the traditional poor man's covered call, we want to mimic as close as we can. We want to mimic having the delta be as close to what 100 shares would be for us, which means you have to bring it down to a delta of 0.90. Okay. So that's going to cost you $6,637 for that call. So we're going to go ahead, and this is a 100-day call. And oftentimes we'll do this on leaps. If I'm going to do this, sometimes you see in my write-ups, you'll see that I do leaps. So 365 days, you can go out. And if you're going to do that, then you're going to come down and you're going to go to 90. And that's $8,900. Now, let's do that one. Okay. So we're going to come in here and we're going to buy Amazon. And you're going to have this call way down here. It's deep in the money, $8,900. And it's going to act as if it is basically 100 shares of of Amazon. And so just shy of 100 shares. So if it goes down, if the market falls, it's going to actually lose as if we had 100 shares, right? But what we have is we have what's called convexity. And convexity actually works in your favor in the sense that if the market starts to fall, delta will start to rise, which means you'll start to lose money more slowly. If the market goes up, delta will increase and you'll start to make money more quickly. That's one of the cool things about options, is that they have this convexity statement involved, which is this delta. And if the market goes up, delta rises, you make money more quickly. If the market falls, delta goes down and you start to lose money more slowly. So this is the traditional poor man's covered call. Now, of course, you want to be strategic about when you put these things on. It's like buying 100 shares. Do you want to be buying 100 shares in Amazon right now? Drive 1, drive 2, drive 3, drive 4. We're at the top of a fourth drive in Amazon. Do you really want to be putting on a 1-year option on Amazon right now? You have to ask that question, because there's a high likelihood this thing could pull back. And how far would it pull back? Well, we're just going to do our technical analysis, and our Fibonacci ruler says that this thing could pull back to somewhere into the Fibonacci sweet spot. So do you want to be buying 100 shares or a long-term leap option on Amazon as it's breaking all-time new highs, going into a fourth drive before it's had some kind of a blow-off profit taking? Now, it had a little blow-off profit taking right here, so you could technically come in here and say, well, this is really just drive 1, drive 2. We're going into drive 3 right now. I mean, you could say that, okay? And both are right. How can both be right, Land? Well, they're both right. The only way you'll know is hindsight. So you just do your best swag, right? It's a scientific wild-ass guess. But right now is probably not the best time to be putting on one of these. In fact, let's go and cancel this one. You know what would be a better one to put it on? Would be Tesla or Apple. Apple might not be a bad one too, because Apple's beat up really bad, and we're anticipating a rise in Apple, aren't we? So we kind of got one on Apple. We got long 100 shares, and we're selling a call against it. But let's go look at Tesla. Tesla's been beat up really bad. We've been down in here, drive 1, drive 2, drive 3. We're going into a fourth drive down on Tesla. So what we'd really want to do, again, today is not the best day to be putting this on, because Tesla's still coming down. We want to wait for it to kind of give us this little bounce right here. We're getting into a little head and shoulders. We thought this was it right here. I bought a little bit of Tesla. I didn't buy a whole bunch, but I did buy some Tesla, and it's losing money on me right now. So I'm going to I thought that we might get a little pullback here, right? And this would be our head and shoulders, and we'd look for this thing to go up, because we are in the third drive down, the major third drive down. So we have to move this whole little thing down one more step, right? So we're going to come down, and we're going to put it down here, and then we just redraw the whole thing all over to go with this next step. So that's kind of where each time you get a new low, you just redraw your head and shoulders, and we don't know where it's going to stop, but we're going to guess right down in here somewhere. And then that's where it would turn around. And we would anticipate that maybe Tesla's going to take off out of this bottom now. All right, so this would be your head and shoulders, or what we call the Wyckoff spring. So if it comes in here, the olden days we called it Wyckoff spring. Nowadays we call it head and shoulders. So as it's coming down to your head and shoulders, we're going to make the new head, and then we're going to anticipate the rise here. That would be the place to put on your covered call. Not right now, but I'm teaching the lesson, so I have to do it today. Can't teach you without doing it. I can't always wait for 3 months to teach you the right thing, to teach you the lesson. So I can teach you the lesson today, and then you can do it at the right time. So here we go. We're going to come in. We're going to buy a 365-day option. We're going to go 372. Look at the volume. That's good right there. We got a whole bunch of people got that one. That's at the money, but we don't want at the money. We want delta of 90 right there. Leap, $9,000. Buy. Okay, so we got an option that we're going to buy way down here, and we're going to come in, and we're going to mark it into this, and there we go. So now we have our 100 shares at a delta of 90. So it's simulating that we have 100 shares. So now we're going to come up, and now we're going to go in, and we're going to do 30 days. And in this case, we got 36 days. We're going to sell a call, and we're going to sell a call above the current market price, 1 or 2 clicks up in here where we think that market's going to go. So we're going to collect $300 in rent. You could put it right on. It's headed down. Why not? There, I want $500 in rent. There's $490. All the market has to do is go above that line, and you'll stop making money on your long call, but you'll collect $490 on your rent. So we drop that thing in there. We hit market, and all the market has to do now is, if it goes up to this point, our shares will make, or our long call, in the money long call, will make very close to $2,000. We'll make an additional $490 at that point. Anything above there we don't make. All right. It'll just stop making money. But you get to keep your $495, and anything between where the market's currently trading when you put this on and that red line is your profit. Okay. Profit on the option that you just bought. That's a real poor man's covered call. All right. So let's go ahead and do that. We're going to come in here. We're going to mark it into that one. All right. So we just collected $490. Now remember, we have a T square. So we have a profit of $490 right now. It's ours. We can go spend it. We can go do whatever we want with it. We can buy more shares with it. But we have $490. But we also have a liability of $490, right? Remember, we still have a liability of $490. And how do we make that $490 turn to zero so that we don't have a liability of $490? It's that premium per day. Okay. $13.75. That's what that column's telling you. That column that we just learned about when we were over there doing the options in the futures market, that's now your income. That's not how much you're losing. It's how much you're making, because you sold the option. You didn't buy it. So if you sell the option, you're going to make $13.68 a day. So now if we come back over here and we think about it that way, these are 14-day out. $175 is what it's going to cost you. You're going to lose every single day. Well, if you were to sell these options and use a sell option strategy, you'd be collecting $175 a day, not losing it. All right, guys. Hopefully that's clear as mud. Did that help? I hope that helped. All right, guys, that's our class for today. If you have any questions, put them out in the comments. If you thought this was a helpful class, I do have a Sunday school lesson for you. Trading is like fishing. There's a lot of waiting and searching for just the right fishing hole. Then throw your line in the water and hope for a bite. Sometimes you catch a small fish, sometimes you catch a huge giant fish, and sometimes you lose your bait. It's rare to catch the big fish, more likely to catch the small ones, but lots of small fish are still good eating too. All right. All right, guys, if you have any questions, let me know. If you like this class, if this was a good class and you felt like you learned something today, give me a thumbs up. That's always what I look for. I like the thumbs up more than anything else. Great to have you guys along. Come and join me in the live class at the university starting next Monday evening in the Udvar Hazy building, second floor. Same bat channel, same bat place. I am Batman. I'm a 60-year-old man. I'm talking like a kid. It's all right. We're young at heart, right? We loved those Batman shows when we were kids. Still stick with you. All right, guys. We will catch you tomorrow's Friday. We'll see you on Friday.